Hi, this is Anthony and welcome to Property MetriX. In this video, I'm going to explore the very important question of should you keep money in your bank or go and use it to buy property? This is a very important topic because there's a lot of first-time buyers who may have the deposit right now to buy property, but just putting the decision off, and they rather keep the money in the bank and save up more money until the right time to buy property. Now, I'm here to tell you that's a bad strategy, a really bad strategy. You should not keep any money in the bank or very little. The only amount of money you should keep in the bank is the money you need for your day-to-day expenses. And maybe you have a little bit on the side in the bank. Do not keep money in the bank because money kept in a bank account is being burned a hole into. It is losing its value every single year. Money in a bank account is like a car. It's a depreciating asset. Every year it loses value. And this is because of inflation. So to just introduce you to the concept of inflation. So what is inflation? Inflation is defined as the general increase in prices and subsequent reduction in purchasing power. So what does that mean? Every single year, things get more expensive. Chocolate bar becomes more expensive. Loaf of bread you eat becomes more expensive. Holiday becomes more expensive. Things become more expensive. Just look at your grocery shopping and look at your shopping basket. I know when I compare my shopping basket in 2019 to my shopping basket today, it is nearly 100% more expensive. Think about that. I typically buy the same thing each week when I go shopping. I don't really vary what I put in my basket. And when I think about what my basket used to cost in 2019, 2020 versus what my basket costs today, I am telling you the average prices of the things in my basket have gone up by minimum 20% a year. The Bank of England claims that they have an inflation target of 2%, that prices shouldn't really increase by 2% a year, which means that your wages typically rise about 2 to 4% a year. So if your wages are increasing by 2 to 4% a year and prices are increasing by 2% a year, then effectively you're not losing any purchasing power. You're not impacted by costs going up because your wages are going up. So as a net, you're okay. But that's a lie. That's a lie. Look at the data they produce and compare that to your actual cost base. Does it look like your shopping basket's gone up by 2% a year? Does it look like the clothes you buy, your takeout, whatever you spend your money on, does it look like it's going up just 2% a year? No. So ignore the government data saying, costs only rise 2% a year. It's been going up 2% a year for the last 10 years. Rubbish. Absolute rubbish. Absolute rubbish. So if you think of that, now let me explain the concept another way to you. Let's say you're getting a 3 to 4% pay rise a year, but the things you buy with your money is going up 20% a year. What does that mean? That means every year you're losing 16 to 17% of your purchasing power. Every single year you can purchase 16 to 17% less than what you could do the previous year. So don't keep money in the bank, because if you keep money in the bank, you and I know, if you look at your interest statement from your bank right now, what are they paying you? 1%, 1.5%, 2%. But if you're gaining 1.5% to 2% on your money in your bank, and the things you're buying is going up 15, 20%, doesn't make any sense, doesn't it? Because if your money is growing 2%, but things are becoming 15% or so more expensive, and as a net, you're losing a lot of purchasing power each year. And if you extrapolate that over 10, 15 years, if you've got £50,000 in the bank today, in the next 5 years, that's probably going to be worth £40,000 or less, based on what you can actually buy with that money. So I know inflation is a very heavy concept to get your head around, but think about it this way. If you have £1 today what that £1 can buy today is going to be very different from what that £1 can buy tomorrow. And just look at it in the simplest way. And I love to use a chocolate bar as an example because, I like chocolate. My £1 10 years ago could buy me about two of the majority of chocolate bars I like. About Bounty, Kit Kat, whatever. I could get two for my £1. If I go to the shop today with my £1, let me tell you this, I can't get more than one. So basically what that means is my £1 can only buy me half of what it used to be able to buy me 10 years ago. Secondly, when I do pick up that chocolate bar and I inspect it, I'm like, is it me or does this thing look smaller to me? Because it bloody is smaller. So not only are they saying we're paying a bit more for the things we used to buy 10 years ago, it's getting tinier. Okay? So that means that's inflation. Inflation just means what you could buy with your money today, you're not going to be able to buy with your money tomorrow. So that's a simple concept of inflation. Now, in order to beat inflation and to keep your wealth and your purchasing power increasing, you need to diversify your money into property. Property is an excellent way to continue to keep your purchasing power increasing, because if inflation is 5%, property values are going to rise at least at that rate or higher, because what you find is assets tend to rise at a much higher rate than the general rate of inflation. So if inflation is 10%, property is going to rise higher than 10%, because that's why they call hard assets like property and gold inflation hedges, because these hard assets increase at a faster rate than inflation. So I really want first-time buyers to really understand what I'm trying to say. Do not sit on money in bank account, saving the money to build up your deposit to buy a home. That's not sensible at all, because every year you're saving money, the money's value is less. So you're going to have to save even more. And it's like, you may never reach that saving target, because if you're saying, okay, I need to save 20% more to get to my ideal deposit level, by the time you get to that 20% more, property price has probably gone up 40%. So then you need to save another 20%. Then property prices go up by another 20%. So you're always going to be chasing your tail if you do that. Because remember what I said, you are saving a depreciating asset in pounds, trying to chase after an appreciating asset. That's not wise. Do you know what people I speak to, I'm saving up for my property. I always say, listen, don't save for a property. Buy now, and then let the property you buy appreciate and sell that or release equity for the deposit to buy your dream home, because the asset is going to appreciate faster than if you try to save money in the bank. Okay, I'm going to show you the data and walk you through some numbers to just explain this concept in more detail as to why keeping money in the bank and saving money is not very sensible to do. The best thing you can do as a first time buyer trying to save up to get on the property ladder is this: just buy a property, buy any property. Just buy a property, buy any property, even a starter home. Because having your money invested in an appreciating asset is much better than investing your money is much better than investing your money in a depreciating asset. If I said to you, save your money in cars, buy cars with all your money and that's going to be your saving. You say to me, Anthony, are you crazy? A car is going to go down in value. Why am I going to take my savings and buy a car and expect that to give me a deposit for a house? By the time I drive that car out of the showroom, it's lost half of its value. Are you crazy, Anthony? But that's exactly what you're doing when you keep money in a bank. A bank is like a car, it's a depreciating asset, because every year inflation is reducing the value of your deposit in your bank. So after 5-10 years, your money in the bank is probably worth not much dissimilar to buying the car. So I'm going to show you this in numbers to help you understand exactly what I mean, that don't keep money in the bank. If you're a first time buyer, use it to buy a starter home, and then when the property increases in price, release the equity to then have a deposit for the dream home later. And it's better to actually have money in the property and then you save up alongside the equity increase. So whilst you benefit from the property price appreciation, you're then saving some to get you to the goal you need to buy your dream home. So let me explain that with some numbers. So here we have the Property MetriX inflation model. And this just building on that concept I was explaining around inflation and how it erodes the value of your money, and why keeping money in a bank is not a sensible thing to do if you're a first time buyer saving for a deposit. So let's say that right now you have £50,000 in your bank, and your bank was giving you or paying you 2% a year of interest, which is very generous because banks right now are probably closer to 1%, even less. Especially at deposits of this size, you're seeing a lot lower than 2%, but let's just say 2%. And let's say the average inflation right now is 5%. I explained that the Bank of England targets 2% and would say to you that inflation's been 2% over the last 10, 20 years, but that's a lie. And if anyone tells you inflation's been 2%, just ask them to look at their shopping basket and explain to you if the price of loaf of bread, chocolate bar, takeaways, and all that kind of stuff has gone up 2%, because you and I know it has not. The actual rate of inflation, the real rate of inflation, because inflation, according to the government, is basically a basket of goods they choose to track. And those basket of goods, sometimes has very little reflection on what the average person does buy. So just bear that in mind. So the actual rate of inflation, it's probably been closer to 5 to 10% annually for the last 10, 15 years or so. So let's look at that. So let's say the inflation rate is 5% and you're earning 2% from your bank in terms of that's the interest they're giving you on your deposit. As a net, you're losing 3% of your purchasing power each year. So your money is losing 3% of its value every single year. So if you look at the data here, if you had £50,000 in the bank, by next year, that's lost 3%. So that's, £1,500 less. It's worth £1,500 less. That £50,000 can buy you only £48,500 worth of stuff. Let's fast forward to 2030. That £50,000 by 2030 would now only be worth £41,649. So you've lost nearly £10,000 of your purchasing power in 5 years. And if you kept that £50,000 in your bank, by 2050, that's now only worth £22,648. So you've lost nearly £27,000 of your purchasing power. So imagine saving up for a deposit with property prices increasing and your value of a deposit decreasing. When would you ever be able to get on the property ladder if you're keeping your money in the bank? Now, let's run a more realistic model then. Let's say your bank savings only 1% and inflation is probably close to 7.5%. Now, let's run a more realistic model. Let's say that your bank savings rate or your savings on your deposit is paying you 1%, and the rate of inflation is actually 7.5%. That means you're losing 6.5% of your purchasing power each year. And as you can see, by the time we get to 2050, your £50,000, the real purchasing power of that £50,000 is only going to be £8,711. So you've lost about £41,000 of your purchasing power, or nearly 83% of the value of that cash in your bank. This is why you should never keep more in the bank than what you need for your day-to-day expenses, and maybe a little bit of money you keep, as a backup. Do not keep large sums of money in the bank. All the people who I know with money have very little cash in the bank because they understand the concept of inflation. That if your money isn't increasing faster than inflation, you're losing purchasing power, you're losing wealth. That's not sensible. So if your money isn't growing faster than the cost or general cost of the things you buy with your money, then you are losing purchasing power every year. So if you are saving up for a deposit, keeping your money in an instrument that loses purchasing power is not sensible. So if you have a deposit to buy a starter home now, but potentially not your dream home, buy the starter home, and then when you get property price appreciation and you make some capital gains on the property, you can sell it to trade up to your dream home, or you can release the equity to get your dream home. If you are just starting your journey and you're looking to save up to buy your property, keeping the cash in the bank is not sensible. I would say look at where you can invest your money. Could you buy some tech stocks or some tech company shares? Could you have another instrument that increases faster than the rate of inflation? Because that's the key. Whenever you are saving your money or whatever instrument you put your money in, make sure that instrument rises faster than the rate of inflation, or else you're losing the purchasing power of your money, and that means you're going to be saving twice as hard to achieve your savings targets, because as you are saving, property is increasing in value, so your cash in the bank needs to be increasing at least close to what property is increasing at to be able to achieve your savings targets, or else you're going to be chasing your tail. Hope you found value in that explainer of inflation and the impact that inflation has on your cash in the bank. And please, when you do hear any government targets, just take them a bit critically, because they are often not in touch with reality. For a long time, when I was an economics student, I used to believe in the 2% inflation fantasy. But as I started to understand more about financial markets, money supply, inflation, and all these kind of things, I was firmly convinced that we've never been at 2% inflation for the last 10 years. No way. Inflation has been running a lot higher than this. Inflation has been cooking a lot higher than what we think. We just weren't aware of how financial markets actually work. But whenever you hear this 2% inflation number, please raise your eyebrow at that number, because that's not true. The real rate of inflation is between 5 to 10%, and you're going to see an accelerated rate likely going forward. So property is going to be higher. The things you buy potentially were a bit higher. So whatever you do, do not keep money in the bank. Ensure that any money you have is increasing faster than the rate of inflation to maintain your purchasing power. Hope you found value in that video, and if you did, please like and subscribe to the channel, share with friends or family of anyone who may get benefit from this information, and please also join our Property MetriX community. We're building a community in Discord where we're giving all the information you need about property, how to purchase property, how to make sensible property purchasing decisions, how to get on the ladder for free. We are basically giving you our expertise, our brain, all of our skill sets for free. We're not charging you for this. So please join our Discord. Please help us build our community. Please tell other people about our community, because what we're trying to do is build the biggest, most value-packed first-time buyer property community in the UK. Thank you for tuning in, and I hope you enjoyed the content, and I'll catch you on the next one. Take care.